Hello and welcome to CryptoverseXplorers. In this episode, titled, Navigating Crypto Taxes, Tips and Tricks, we're going to demystify the complex world of cryptocurrency taxation. Whether you're a seasoned investor or new to the crypto space, this guide will help you understand how to stay compliant with tax regulations while optimizing your tax liabilities. Understanding crypto taxation basics. Cryptocurrency taxation is a complex but essential aspect for investors and traders to understand. In many jurisdictions, cryptocurrencies are classified as property for tax purposes. This classification has significant implications. Like stocks or real estate, any gains or losses realized from the sale, trade, or exchange of cryptocurrencies are subject to capital gains tax. This part of the video will elucidate the concept of capital gains in the context of crypto, how gains are calculated, the difference between realized and unrealized gains, and the implications of these gains on your tax obligations. A key component in understanding crypto taxation is the distinction between short-term and long-term capital gains. This is important because different tax rates often apply based on the duration you held the crypto assets. Short-term capital gains typically apply to assets held for less than a year, while long-term gains apply to those held longer. The rates can vary significantly, with long-term gains often taxed at a lower rate, incentivizing longer holding periods. Furthermore, not every interaction with cryptocurrencies triggers a taxable event. It's crucial to understand what activities are taxable. Selling cryptocurrencies for fiat currency, like USD, EUR, etc., using cryptocurrencies to purchase goods or services, and trading one cryptocurrency for another are all examples of taxable events. In contrast, transferring crypto between your own wallets or purchasing crypto with fiat and holding it are generally not taxable events. We will dissect each of these scenarios to provide clarity on what triggers tax liabilities and how they are assessed. Keeping accurate records. Effective management of crypto taxes begins with meticulous record keeping. Every transaction involving cryptocurrencies needs to be recorded, as this data forms the foundation for calculating tax liabilities. We will discuss the importance of maintaining detailed records, including dates of transactions, the value of the cryptocurrency in fiat at the time of the transaction, transaction amounts, and the nature of the transaction, e.g., buy, sell, trade. Given the volatility and complexity of the cryptocurrency market, keeping track of every transaction can be daunting. This is particularly challenging for active traders or those using multiple exchanges and wallets. We'll highlight tools and software solutions designed to simplify this process. These tools can automatically track your transactions across various platforms, providing consolidated reports that are invaluable for tax purposes. We'll also explore how to effectively consolidate and manage your transaction data. This includes tips on organizing your records, understanding the kind of information you need to keep, and how to use this information when calculating your taxes. Whether you're a casual investor or a high-frequency trader, these strategies will be crucial for maintaining accurate and comprehensive records of your crypto transactions. Calculating gains and losses. One of the most critical aspects of cryptocurrency taxation is accurately calculating gains and losses. Due to the volatility of the crypto markets, this can often be a complex task. The first step in this process is determining the cost basis of your crypto assets. The cost basis is essentially the original value of the asset for tax purposes, typically the purchase price, including fees and other associated costs. When you sell or exchange your cryptocurrency, you must calculate the gain or loss from the transaction. This is done by subtracting the cost basis from the sale price. If the sale price is higher, you have a capital gain. If it's lower, a capital loss. We'll guide you through examples and scenarios to make this concept clearer. Another critical factor in calculating gains and losses is the accounting method used. The most common methods are FIFO, first in, first out, and LIFO, last in, first out. In FIFO, it's assumed that the first assets you purchased are the first ones sold. Conversely, LIFO assumes the last assets bought are the first sold. The choice of method can significantly impact your reported gains or losses and, consequently, your tax liability. We will explore these methods in detail, providing insights on how to choose the most beneficial and compliant method for your specific situation. Dealing with airdrops, forks, and staking. Cryptocurrency taxation extends beyond simple buy and sell transactions. Airdrops, forks, and staking rewards represent additional layers of complexity. Airdrops, where tokens are distributed for free, typically as part of a marketing or network expansion strategy, are usually considered taxable income at the market value on the day they're received. Hard forks, which occur when a single cryptocurrency splits into two, can result in new tokens. Tax liabilities in this scenario depend on various factors, including whether the new tokens are seen as having been sold or held. We will discuss the nuances and tax implications of such events. Staking rewards, earned by participating in network validation, for proof-of-stake cryptocurrencies, are also a taxable event. These rewards are often taxed as income at their fair market value at the time of receipt. We'll delve into the details of how to report these forms of income and the various considerations you should be aware of. International crypto taxation. For global crypto investors, the tax landscape becomes more complicated. International crypto taxation involves understanding and navigating the tax laws of multiple jurisdictions. We'll discuss the implications of cross-border transactions, including how tax treaties and residency status can affect your tax liabilities. For expatriates and digital nomads, managing cryptocurrency taxes can be particularly challenging. Different countries have varying rules about foreign asset reporting, taxation on global income, and residency definitions. We'll provide essential tips for managing these challenges, including how to determine your tax residency, the need for declaring foreign assets, and strategies for legal tax optimization. The segment will also touch on the importance of staying compliant with regulations like the Foreign Account Tax Compliance Act, FATCA, and the Common Reporting Standard, CRS, which require disclosure of foreign assets and income to prevent tax evasion. Tax reduction strategies. While paying taxes on your cryptocurrency gains is mandatory, there are several legal strategies that can help minimize your tax liabilities. One effective strategy is tax loss harvesting. This involves selling cryptocurrencies that are at a loss to offset the capital gains tax liability on other investments. We'll guide you through the process of tax loss harvesting, including timing and compliance considerations. Charitable contributions are another avenue for tax optimization. Donating cryptocurrency directly to a qualified charity can be more tax efficient than selling the crypto and then donating the cash. This is because such contributions may not only provide a tax deduction but also avoid capital gains taxes on the donated crypto. We'll explore the nuances and benefits of this approach. Investing in cryptocurrencies through certain retirement accounts, like a self-directed IRA, is another strategy to consider. These accounts can offer tax advantages, such as deferring taxes on gains until retirement or, in the case of Roth IRAs, potentially tax-free growth. We'll delve into how these accounts work with cryptocurrencies and the rules and limitations involved. Each of these strategies requires careful consideration and planning. We'll discuss how to effectively implement these strategies while remaining compliant with tax regulations. Handling tax audits and disputes. Facing an audit from tax authorities, especially concerning cryptocurrency transactions, can be a challenging experience. Preparation and understanding your rights are key to effectively handling a tax audit. We'll provide insights into the audit process, including what triggers a crypto tax audit and how to be prepared if you are audited. Maintaining comprehensive and accurate records is your first line of defense in a tax audit. Detailed records of your transactions, including dates, amounts, and the purpose of each transaction, are crucial. We'll discuss the types of documentation you should keep and how to organize them. In some cases, it may be wise to seek professional help. We'll talk about when to consider hiring a tax professional or attorney specializing in cryptocurrency, and how they can assist you in navigating the audit process. Staying updated and seeking professional advice. The landscape of cryptocurrency taxation is constantly evolving. Staying informed about the latest tax laws and regulations is crucial for compliance and effective tax planning. We'll discuss resources for keeping up to date with these changes, including government publications, reputable crypto tax platforms, and industry news. Given the complexities of crypto taxation, consulting with tax professionals who specialize in this field can be highly beneficial. We'll explore the advantages of seeking professional advice, including ensuring compliance, optimizing your tax strategy, and gaining peace of mind. We'll also highlight the importance of choosing the right tax professional, one who not only understands the intricacies of cryptocurrency but also stays abreast of the latest developments in tax legislation affecting crypto assets. Navigating crypto taxes can be complex, but with the right knowledge and tools, it's manageable. Remember, staying informed, maintaining accurate records, and understanding your tax obligations are key to successfully managing your crypto taxes. Thank you for tuning into Cryptoverse Explorers. If you found this guide helpful, please like, subscribe, and share your thoughts in the comments. Stay with us for more insights and tips on navigating the ever-evolving world of cryptocurrency.